Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us a regular guest. If you want the real numbers, if you want the unmassaged, ungimmicked up numbers to give you a clear picture of what's going on in the financial world, the man you turn to is Economist John Williams at shadowstats.com. And John Williams is back with us today. Thank you, John, for joining us from California.
Thank you for having me, Greg.
And listen, the numbers were just in the last, week or so. GDP, a huge miss, less than half of what it was supposed to be. Durable goods down, manufacturing down, business spending down, GDP, trade deficit widened, service sector shrinking, business spending down. What is all this pointing towards? Is the economy really good as a lot of people on the left and President Obama say it's great. America is already great. Is the economy really good, or are you seeing something different?
I love America, but we're in a deepening recession. The economy collapsed into 2009. As I've been talking with you regularly, we never really recovered from that. You had some bounce higher, but generally you went into low-level stagnation, and now it's turning down again. We're seeing that in a lot of numbers. We even just had a benchmark revision to the GDP, which was nonsense. The numbers are a lot weaker than they appear. There's no question we're in a recession, and you don't need negative GDP to have a recession declared. The National Bureau of Economic Research, which is the defining authority, will declare it based on things such as retail sales and industrial production, and we have one. There's no question about it. It's just a matter of when it's going to be recognized, and you will see downside revisions to these weak numbers that we're getting right now.
So the 1.2% GDP was supposed to come in at 2.6. So that you're saying that the GDP at 1.2% is really weaker than 1.2%? How weak is it?
Well, it's probably in contraction. The thing is, I'm not sure the Bureau of Economic Analysis is going to report it as such, but I think they're going to take it lower. Usually, when they come out with their first estimate, they're guessing. They come up with usually they come up with a high estimate, a middle estimate, and a low estimate. Then they look at the consensus, and they'll tend to bring it in close to the consensus. The consensus indeed was over 2%, but they didn't come in close to that. And when they come in on either side of the consensus significantly, which this was for them, that's usually an indication of where the next revision's going. They're telling the consensus, hey guys, the numbers aren't quite as strong as you're looking at. You better lower your forecast. So you're going to see the consensus estimates drop, and you could even have a contraction next month when they come around to revising the data.
Just your best guess. What do you think? I mean, if their best guess was less than half of what the consensus was predicting, what do you guess that it's going to be revised to? What do you think it'll be revised to? Definitely down.
Well, we have two more revisions. I think it's going to go into contraction again. We're in a recession. You should be seeing contracting GDP, but the Bureau of Economic Analysis did some very funny things with their benchmark revision. Their mission is to report the business cycle as accurately as they can on a timely basis, and there are a lot of good people there that work for that. I've met a lot of them. I know a number of them from talking with them on the telephone, but I've also met them over the years. I've been doing this for 30 plus years, and over the decades, I've met people who've been intimately involved with what's going on. Early on in my career as an economist, I had a client who used to work at the Commerce Department back in the days of Lyndon Johnson, and he told me that Johnson would regularly review the GDP reporting, and if he didn't like it, he'd send it back to the Commerce Department, and he'd keep sending it back to them till they got it right. Decades later, in terms of where things happened, I was advised by people involved in the process that during the administration of George H.W. Bush, this is when he was coming up in a difficult election with the economy falling off, that there was a manipulation of the GDP numbers that was worked with administration influence, but it was done external to the Bureau of Economic Analysis. The people at the Bureau of Economic Analysis were not aware of it until well after the fact. Political manipulation is something that happens on a fairly regular basis over the decades, usually around elections.
And you think it's going on? You must think it's going on now that they're manipulating. They're making it look better than what it really is. Correct?
I'm very suspect of it. Let me put it this way: there are good people there. They're doing their best to come out with good numbers on a timely basis, but that does not necessarily preclude or prevent somebody manipulating the system.
But your analysis is, hey, folks, we're already in a recession. It's much worse than what they're telling you. Is that right?
It is, and in fact, if you just consider this with a benchmark revision. They only revised for 3 years. Now, come 2018, we're going to get a real benchmark revision that goes back to 1929. But what they did here did not change the average GDP. It smoothed it out, where you had effectively no growth in the second quarter of 2015, which I think will, first quarter of 2015, which I think will be the first quarter of what will be recognized eventually as a new recession.
Now, 2015 or 2016?
2015.
Ah, okay. Wow, we've already in a recession since then. Holy smokes.
That's when industrial production started to contract. And industrial production, I think, will be used as the timing element here. But instead of having that a dip in growth in the first quarter of 2015, they just averaged it arbitrarily with the second quarter, and now that weak growth has disappeared. Nice smooth line now.
Well, hold on a minute. So you're saying, I just want to get this straight now. You're saying that you're going to say the recession really started in the first quarter. When we look back on this, you're saying your statistics and your analysis shows that we're going to look back on this and say we started a recession in the first quarter of 2015. Is that what you're saying?
Actually, it'll be timed from December of 2014, but You'll see the first quarterly contraction. That's when it should be. Let me just be a little more explicit here. I've been talking about this for some time, but what happened? Extraordinary here. We saw benchmark revisions to industrial production earlier this year. I think it's back on April 1st, around then, and some unusual things happened. They were getting reporting of some better quality surveys earlier in time. Before this, manufacturing had recovered from the recession, and industrial production generally had recovered its pre-recession high. After the revision, manufacturing was below its pre-recession high. It never recovered from the collapse into 2009, and industrial production was revised lower, and all of a sudden now is showing a contraction. The industrial production, which represents 65% of the gross domestic product, that's as calculated by the Federal Reserve, did recover in 1 month, which was November of 2014. Then it started turning down again, and right now it's down 1.5% from its pre-recession high. Pre-recession being the 2007 recession. Now consider that with all these revisions, and these revisions were after last year's GDP revision, and it represents 65% of the GDP. The GDP didn't revise lower. It should have. Right now, the GDP is 10.6% above its pre-recession high. In order for those numbers to be consistent, it means that the GDP, the 35% that's not tied to the industrial production, is 33% above where it was before the recession. And my friend, if that's the case, Donald Trump would not be the Republican nominee. The voters are telling you, we've got a problem here. They sense it. The average guy, Main Street USA, knows what's going on. That's what's giving you such an unusual election year. And you can't discount that. Main Street USA knows a lot better than the bureaucrats in Washington, particularly when you're in an election year and somebody may be tempted to try and play with the numbers a little bit.
You're saying there's no, it's just like the old adage is, you can't fool Mother Nature. You can't fool the man on the street. They're saying
Absolutely.
everything is fabulous, and the man on the street is saying, no, not fabulous.
Consider the efforts that took place during the first Bush administration, I mean, with George Senior. Uh, there was, I know for a fact that there was a manipulation there that boosted the GDP reporting. You may remember, that was the economy was weakening. All of a sudden, the numbers get a little better, and people are real happy about it. Except uh, the opposing candidate at that time, Bill Clinton, came up with "It's the economy, stupid." The average guy didn't recognize that the economy had turned. It was reported as such, but it was nonsense. It was the average person knew that had not happened, and that's probably more than anything else why Bush lost that election.
And
Because
now you're saying the
people,
reverse has happened.
people, this is the first. People vote their pocketbooks. It's happened over time, and even with the government's numbers as reported, the pocketbooks would suggest a vote against the incumbent party currently holding the White House would lose. Now, this is an unusual election because you have a Republican candidate who's non-traditional, non-establishment, and the fact that he's pulled so many people out of the woodwork who had been voting for the last number of elections because they didn't see any change. Now we're looking for a change. They know there's a problem. That's why that's why Trump is where he is, and it'll be very interesting to see how this works out. But I can tell you that the economy, what's unfolding here, is not going to, in the reality, and what the average guy's going to be seeing is not going to be improving before the election. It's going to get worse. If this were not an election, the Fed would be looking at uh, expanded quantitative easing, because a recession, and there are things that will happen here, irrespective of how it's reported by the Bureau of Economic Analysis. It hurts. It puts stress on the banking system. It hits government spending and funding, so that the Treasury funding is going to be an issue going forward here. And the funny thing about the quantitative easing, although it's not talked about much, uh, the headline deal, and indeed the Fed would always cite it. We're doing this to stimulate the economy. We have a mandate to maintain employment at a certain level, and to keep inflation at within a certain range. That was nonsense. I mean, yes, they have that mandate, but the Fed's primary function is to keep the banking system afloat. And the way they worked quantitative easing did nothing to stimulate the economy. It was all aimed at keeping liquidity in the banking system. Then they pulled back. They stopped buying the treasuries. They're still holding the treasuries they had. But when they were actively buying the treasuries, they effectively monetized 75% of the new issuance of the U.S. Treasury. Now, who's buying the treasuries now with China kicking out of it, and a number of our foreign friends no longer buying but selling treasury bonds? The Fed. And what does the Fed do? Well, it pays the interest back to the government. It's fully monetizing this debt, which will eventually create inflation, or at least it did. It stopped buying new debt. My contention is that as the economy turns down here, and they're probably going to wait till after the election before they make their next move, they're going to move into quantitative easing again, buying treasuries. And
a lot of people are probably sitting here thinking, John Williams, and let me just interject here. A lot of people are thinking, oh, well, they're going to go pedal to the metal. I mean, they're going to try to get Hillary elected. I mean, this is the party in power is Democrat. Republican would probably do the same thing. But you're saying, no, if they start doing quantitative easing now, that could really tank everything. Is that what you're telling me?
well, let me put it this way: when at such time as it happens, and I believe it will, you'll see heavy selling against the dollar, which will tend to hurt stocks. It'll very definitely hurt. I mean, as you get massive selling against the dollar, it's going to start spiking inflation early on with oil prices and gasoline. Very strong correlation, or negative correlation of 80% between what happens to the dollar and gasoline. So the dollar weakens, gasoline prices go higher, and my friend, that's been the biggest variable in the headline inflation numbers since the panic of 2008. And
How
you see gasoline prices rising again. You've got an inflation problem, and that starts all sorts of issues.
and how fast do you think that could turn around? Let's say that, and there's no guarantee that they won't try to do this before the election, and hope we don't get the inflation until after November. They might probably pull this in maybe September or October. Could they try this and hope the inflation doesn't hit until after November, or you think all bets are off until after the election?
The Fed is, I mean, there may be preferences there, and I'm sure there are, but over time, there's been a certain level of integrity there, at least from a political standpoint, that they tend to shy away from and getting involved in the election process. I sure would be looking to shy away from it at this point, particularly if there's a chance that you're going to end up with a president who's going to look to overhaul the Fed. Uh,
Oh,
I,
so you're saying they're on their own? Hillary and Obama, you're peddling fiction if you're saying the economy's bad, and nobody watching this video thinks you are peddling fiction, John Williams. But you're saying that the economy and Hillary and Obama, they're on their own going in past November, correct?
past November, at that point, uh,
I mean, they're
I
not
think
going to do anything before the elections. What you're saying?
I don't think you're going to see any further action by the Fed before the election. And they have a very difficult political balance against the rest of the world. Many ways they want to keep the dollar strong to keep capital flowing in. When they go into quantitative easing, the dollar will weaken, and that creates a number of issues. But they're going to have to do it because number one is preserving the domestic banking system. That's their primary goal. And they're now indicating, we're looking to keep the global system afloat. Well, yes, clearly they've been doing that, and that's tied to also keeping the domestic system afloat. But when you get down to the nitty gritty and things got bad, all the central banks are going to start looking more at the needs of their domestic circumstance and become a little less cooperative in terms of global needs. That would be my bet.
What happens if one of these Italian banks, or I mean, I saw a Credit Suisse chart and Deutsche Bank, and I mean, when your stock chart for a bank starts looking like Deutsche Bank and looking like Lehman Brothers, I don't think that's a good sign. What happens if one of these big banks in Europe, Deutsche Bank or Credit Suisse or one of the Italian banks, or what happens if one of them just, they're having problems with this Italian bailout? What happens if one of them, zigs instead of them zagging and they go belly up? I mean, couldn't that tip off some crazyville before November?
It could. Well, let me put it this way. I would expect if there's something that happens there that would threaten the global system, and with that the U.S. system, which is the largest in the world. I mean, you're looking at the dominant currency, the dominant economy, the dominant banking system. If something happens outside the United States, failure of a large foreign bank, for example, that might threaten the system here, I wouldn't be at all surprised if the Fed stepped in to bail them out if the domestic country was not willing to do so. Because, again, they're going to keep the system afloat as much as they can. That does not necessarily mean quantitative easing right up front. It doesn't mean they have to change domestic policy. But overtly or covertly, these banks that are in trouble, or that the system knows it. And we're dealing with a system that at the moment is very nervous about what's going ahead. Never contained properly the panic of 2008, and will have plans to try and bail out anyone that comes and gets in trouble, including, if necessary, a direct bailout by the Fed, even though it wouldn't be described as such.
Do you think we could have bail-ins, or at some point will we have bail-ins, whether before or after the election? You're saying that the time window is starting to close down. Could you tell us about that? Are we going to have bail-ins where depositors' money's going to get taken and or tied up?
I think the Fed's going to try and keep things as stable as possible through the election. That's in the best interest of the system. They don't want to get in the middle of politics after that. Uh, I think the system is going to the economy is already beginning to do this, but and you're talking a couple of months here. Uh, the economy will be threatening the domestic financial system as it did in 2008, and they'll do whatever they have to do to keep the system afloat. I can't tell you exactly what it's going to be, but they've been creative in what they've done. I think it's been established that negative interest rates don't do anything. I don't think they're going to go to negative interest rates. I
Uh,
think they're just going to liquefy the system as much as they need to, and eventually you're going to end up with a real inflation problem. An area again I've been talking about for years. I've been wrong in the timing as to when it would break, but we still have the same. The fundamental issues are the same. They're in place of us, and they're beginning to unfold.
I'm glad you brought that up. I know you've been wrong in the timing, but this is big, man. I mean, this is biblical. This is not a little small zig or a little small zag, a little recession. This is a huge. When this thing breaks, this is going to be the biggest ever, is it not?
Most likely, yes. I mean, this is it'll be certainly a world class event that people will be talking about for centuries.
Woo! That's some description. A world class event people will be talking about for centuries. And where does that leave gold and silver? I've seen gold and silver, catch a bid, and silver's now up around 20, and gold's 13.50, whatever, somewhere in that neighborhood. Is this the reason why that money players are seeing that things are deteriorating, things are going bad into the election, and they're buying gold? I mean, Jeffrey Gunlock was like, sell everything, buy gold. I mean, he manages $100 billion. Is that why we're getting these terrible warnings from these big players now that are probably listening to you?
Well, I'm sure that's an element of it. I would let me put it this way: I've been bullish on gold for as long as I've been bearish on the dollar and the ultimate collapse of the dollar and a hyperinflationary Great Depression that eventually will unfold. Uh, the best hedge in that type of circumstance are the precious metals, physical ownership of gold and silver. And personally, I prefer coins because they're liquid. Gold over time has preserved the purchasing power of people's assets. Holding the physical gold, it's liquid. But for it to work, and you've seen big gyrations in the price of gold here. It's well higher and sold off, and it's back up some now. Central banks don't like gold or private ownership of them because as the gold price rises, that's a signal that central banks are not doing their job, and they've intervened a number of times to knock it down to try to discourage people buying it. Nonetheless, it's the only asset of that nature, or it's a dominant asset of that nature in terms of being a store of wealth and physically compact, which makes it both mobile and liquid. So that I advocate holding physical gold as a hedge here, but for it to act as a hedge, you don't buy it at 1,300 and sell it at 5,000 because you're making good money. I mean, you can do that. I wouldn't, because if you're at 5,000 or you're at 10,000, it means the crisis is breaking. You need to hold it through the crisis, because when that inflation hits, you may see gold at 100,000, a million. It could be 100 million as the value of the dollar collapses. It's just it's the price of gold will go up as an inverse and value of the what happens to the value of the dollar. If the dollar goes to zero, I mean, you're just way up. What do you do? But once you're through the crisis, holding gold will provide will presumably preserve the purchasing power of your assets, and you can move ahead to you not only having saved your your personal liquidity and wealth, but be in a position to take the tremendous opportunity of what are going to be extraordinary investment circumstances post-crisis.
Anybody with any cash, anybody with any liquidity is going to be able to be in control.
Right. And then the other factor, of course, if this gets as bad as I think it's going to get with the hyperinflation, it makes sense for individuals to protect themselves as they would for a natural disaster. Again, I'm at the moment I live out here in California, not far from some major earthquake faults. People out here, they have a store of water, food, the necessities of life to carry them for a month or two, because you can't count on the government coming in to save you. People around the nation should be doing that from the standpoint of what's clearly unfolding as a man-made disaster, which eventually is going to result in the dollar becoming worthless. And when that happens, and if you get into the crisis, look at what's happening in Venezuela now. They're going through a hyperinflation. You'll have trouble getting food. You may have riots or all sorts of things that can happen. You want to be able to be self-sufficient. And so you buy a store of goods that you would normally use, they're necessities. Buy an inventory of stuff that you normally use, just rotate it. And as long as we're in the silly circumstance where people are talking negative interest rates, or when you're, if you believe the government's inflation numbers, effectively looking at negative inflation, real inflation, you do better to hold stored goods than put your money in a bank account. You make more money with it because of the inflation. So it's a number of angles. That's just a side point, but I would strongly urge people to be protected for a period of disrupted economic activity.
What's your time window for the hyperinflation? I know you've changed this a few times, but this is biblical. If you're off by a couple of years, I personally, I know it's bad. I cover this stuff. What's your time window for the hyperinflation? When do you think it starts hitting, if it hasn't already hit?
Well, it'll hit once you start to see the massive selling of the dollar. That'll trigger a number of things, including likely dumping of the dollar by those holding dollars outside the system. Massive amounts of dollars there that the Federal Reserve is going to have to absorb. Once you start to see a panic decline in the dollar, I'd be real cautious, because it can happen quickly, and it would tend to follow that. You'll see a decline in the dollar first.
And
Backing off, what would likely trigger for the sell-off in the dollar is the Fed moving back to quantitative easing. But here, the key point is that back in 2008, they made the decision to save the banking system at all costs. They took all sorts of measures to guarantee whatever needed to be guaranteed, to create whatever money was needed. They bailed out whatever companies they had to bail out. But they didn't. They never addressed the underlying problems. They just pushed the problems into the future. We still have those problems, and now as they find themselves being pushed back into quantitative easing to keep the system afloat, that'll be the proximal trigger for the massive selling of the dollar and the early stages of the inflation. Once you see massive decline in the dollar, I would most certainly want to be in a physical gold.
Well, that's going to dry up in a hurry. I mean, the gold market is not very big. I think that's why you're seeing these, the movements in silver and gold now. I think they see this coming, especially with these Bill Gross and Jeffrey Gundlach and all these.
I'm certainly seeing what's happening. It does not preclude, as we have seen, intervention by the central banks or other interested parties in knocking down the price of gold or silver. The point is, if you buy gold at 1,300, 500, you buy it at 5,000, you're still going to be doing okay, because this is once you have the panic hit, the sky is literally the limit there, but you have to ride out the crisis if it's going to have the effect of preserving your wealth and assets. If you sell out at 100,000 and it goes up to 100 million, you still have lost all your purchasing power effectively. You need to get through the crisis.
And you're saying the bond market's going to be destroyed. I mean, destroyed. The stock market is going to be destroyed. Those two markets are going to be crushed in what is coming. Is that your forecast?
Well, the bond market is not going to do well. Among other things, you get inflation, you will have higher interest rates. That will be forced, and higher interest rates in this environment would certainly kill bond prices. Now, stocks are something of an inflation hedge. You look at them over time; they've done reasonably well in keeping up with the CPI. Not as well as gold has, but in terms of the headline inflation, they'll move along with the headline inflation. You get into a hyperinflation, it'll certainly move higher. But my expectation would be there that if you took the value of stocks and deflated them by what was actually happening to inflation, you'd find that in real terms, net of inflation, that you're losing money. And we get into the crisis that we've got ahead here. I'm not even sure you're going to have much liquidity there. I would stay away from paper securities and paper money, physical gold, and silver.
And one last thing, and I want to kind of nail you down on this. And you say the approximate trigger is the selling of the dollar. You don't think the selling of the dollar, and what I'm hearing, and correct me if I'm wrong, that you don't think the selling of the dollar won't happen until after the November election. That's when the Fed will be freed politically to do what they want. But all bets are off. I mean, if things get bad, they might have to do something. What's your window of time? When do you think this hyperinflation is going to begin now? I know you've called it in a couple of years prior, and you've said you've been off, and I'm not trying to put you down for that. But what is your new window of time that this is going to happen in?
Well, it's a type of thing that could, I mean, you could have a crisis at any moment. The circumstance is not stable, either with the economy or with the global financial system or the banking system. It's possible that if the banking system breaks apart or comes under severe stress before the election, that the Fed would be forced to move. But my betting will be they'll do everything they can to hold off until after the election. So I'd say most likely the dollar sell-off will come after the election, but anything's possible here. And once the dollar sell-off starts, I'd say you're going to be seeing the stages of early hyperinflation well within a year. So let's say late 2017.
We'll be into it by late 2017. We lost connection there on Skype. John Williams of shadowstats.com. Thank you very much for joining us on usawatchdog.com. You can go to shadowstats.com and become a subscriber to ShadowStats. It's very inexpensive. I think it's less than a couple $100 a year. Very detailed reports. John Williams, thanks for joining us today on usawatchdog.com.